All right. Well, thank you for coming to the GBA event. This is a monthly event that we do on blockchain and financial institutions. Our speaker today is Paul Dowding. Paul is the working group leader for the GBA Banking and Financial Services Working Group. I have to tell you a little bit about Paul's background. He started as an engineer. I think it was in automotive or aerospace, or certainly non-financial. But he learned a lot about process there. Then he spent a career in banking, in operations, and he was an executive, and really became an expert on both the operations and the technology. And when blockchain started coming around, and he started looking at all the problems that were out there, he said all the existing problems out there, they've got probably, the existing blockchains, they don't scale. There are all kinds of issues. So as he was developing requirements on what they needed, they gave him the idea to create a solution, which he did, called Tapestry X. He is now the head of design for the L4S Corporation. I routinely say that Paul is probably the smartest guy I know in banking and financial services and blockchain and technology. So literally, you got, and I have somewhat of a deep background in this subject, but you guys are really truly listening to an expert today, and a good friend. So Paul, with that, the floor is yours.
Well, thank you, Gerard. As I always say after your introductions, the only way is down from here, but that's all right. But, I hope everyone, appreciates what we're doing. Well, what I'd like to cover, and again, it's in the title, is crypto and the DeFi world that different from traditional finance? And when asking that question, why is that important? And so I want to cover that. I'm going to make the session a bit interactive, so I need people not to be too shy here. And while there's a Q&A at the end, if you really do feel the need to ask a question at some point, then please, I'm okay taking an interruption. But thank you again for everybody for attending. As Gerard said, I've been an active member of the GBA for 4 or 5 years and started heading up the banking and finance group. Been a big part of what was the standards and certifications group that developed the blockchain maturity model, and then also helped develop the supplement for banking and finance, and that's led to other supplements being done around healthcare, identity, voting, etc. So anyway, I'll go on with the topic. So first of all, I'd like to cover some just brief definitions so that we're all on the same page. And most of these are mine, if not necessarily technically what people understand, but I'm just borrowing things. But it's more to get a consistent understanding rather than to be absolutely perfect. I want to give examples of DeFi versus TradFi so you can see where the connections are, where the similarities and differences are. Then I'd like to specifically cover, in the financial services, we talk about clearance and settlement. Ultimately, you're executing transactions, but having agreed or obligated yourself to an execution, there's a process by which that transaction is cleared and settled, so that if you're buying something, you're exchanging money for something, and it's all received clearly. And then I cover why is this comparison important to both TradFi and DeFi, and then a Q&A at the end. So let's start, and this is part of, in terms of definitions, a digital asset is anything that exists only in digital form and comes with a distinct or usage right or distinct permission for use. These assets can be stored and transmitted electronically through a computer or another digital device. So the key thing around this is it's really an electronic record, which most things in TradFi are today. The distinction seems to be digital means it's on a blockchain or distributed ledger, and electronic means it's on legacy systems. But fundamentally, they're all digital, because when you look at digital versus analog, which is the way most people compare things, and digital is information represented using discrete values, such as binary digits. All our computers runs on ones and zeros, and that's the discrete elements that can make all the code work. Everything you look at on a computer, everything you see. In a CD, music, I'm dating myself now with a CD, but even with digital streaming, the music is chopped into very, very tiny pieces, digital pieces, but your ear can't distinguish them from what would be an analog sound if you're playing a vinyl record. It's a purely continuous physical interaction. So again, I'm just making this definition to say that when you're looking at traditional finance that's recorded on computers, whether they're still mainframe or cloud or otherwise, they're technically digital records. So looking at DeFi versus TradFi, I'm going to give you some definitions, and I'd like anybody who's willing to speak up, say what I'm describing. So it's a means of exchange in a trustless network where anyone can participate, and the validation of transfers via a sequence number between two parties is such that the recipient can then easily transfer the value to another participant. What am I describing there?
So this looks like a blockchain.
Or, well, it's a means of exchange where anyone can participate in the validation of transfers of a sequence number between two parties, such the recipient can transfer the value to the other participant. So what's the value? I've stumped everybody with the first one.
Is that a token?
Trust.
It's a cryptocurrency, yeah?
Oh, that's what I was going to say next, Paul.
Okay. All right. So what's the equivalent in TradFi?
Wait a minute. I said token. Does token count as cryptocurrency?
It could be, but well, I'm just trying to keep it simple. So,
okay.
As I said, they're my definitions, so they might not be perfect. All right. In TradFi, cryptocurrency, particularly Bitcoin, is regarded as, digital cash. Now think about it. Cash. You're in a network of people in a country. You have a piece of paper which actually has a sequence number. It has a serial number, and you trust it because you believe you can look at it and say this is not a forgery, so you'll accept it, and other people won't. Now there isn't a digital record as per se, but there technically is a sequence of numbers on the cash. But fundamentally, what I'm saying is that when you look at cash, it's a bearer-based. When I say bearer-based, it means that whoever holds it owns it. And it's transferable in a trustless network because people don't necessarily trust you. They trust that when they look at the money you give them, that it's not forged and it's valid currency. In the same way, you can check a blockchain and say that asset is owned by that person, and I'm prepared to receive it. So here's the next one. A form of currency that can be exchanged via digital updates and is backed by a fiat currency. What's going on in the DeFi world? A form of currency that can be exchanged via digital updates and is backed by.
That's a stable coin.
There you go, stable coin. So now what's the equivalent in TradFi? Any guesses? Well, you could have a gift card or a debit card. Effectively, you're walking around with a form of currency that can be exchanged via digital updates, swiping your card and everything else. So I'm just making the point that really a gift card or a debit card has got fiat currency backing it, and then you can spend it later. Here's the next one. A currency backed by a central bank where the transfer is controlled or overseen by central banks. We've either got a shy audience or we got them worried.
Okay. A central bank digital currency?
That's right, Tyler. Well done. Central bank digital currency. Now, this is a bit esoteric in the sort of global banking world. For what is the TradFi equivalent to this? You may have all heard of the International Monetary Fund. When they actually, you hear that, I always love it when you hear that there's somehow this big International Monetary Fund that can lend and bail out governments. And don't think that's just for poor countries. In the 1970s, even the UK was bailed out by the IMF. But they have what they call special drawing rights. So this is a form of currency that's backed by a basket of central bank currencies, and it's lent to countries so they can pay off their obligations to other countries, and then they can be transferred back. It's actually been speculated that this could be a form of global currency, but as it's only between central banks and governments right now, it's never reached that status. But I'm just making the point that, you know, the idea of central banks controlling currencies is not from a transactional perspective, not just, you know, printing them for their government. Okay. So the process of creating a digital asset backed one-to-one with a digital or physical or legacy asset.
Is that minting a token?
That's actually the process of tokenization. Yeah. So that's what we know in tokenization. So what would you think the equivalent of TradFi is? Remember, we're creating a digital asset backed one-to-one with a digital, physical, or legacy asset. There's actually what they call ADRs, GDRs, and ETFs. So ADRs are American depository receipts. If a foreign country wants to issue shares on New York Stock Exchange, like say Mercedes, they would deposit their German shares in the custodian, which would be escrowed, and then they'd issue one-to-one shares on the New York Stock Exchange. Global depository receipts are obviously any country doing that outside of the US. And then ETFs, if you think about it, the Bitcoin ETF, what do? They buy Bitcoin, they lock it up in an escrow account, and they create a share that can be traded on the New York Stock Exchange. It's and any ETF is fundamentally a form of tokenization. So mechanically, the process is the same. An algorithmic decentralized exchange to trade digital financial products. Well, unfortunately, I've probably given the answer in the definition there, which is when you think about it, it's a crypto or DeFi decentralized exchange. Right? So this is where you can go to a protocol and exchange products, you know, through the protocol. In TradFi, most people obviously are aware of the equities markets and the stock exchanges, but when you get into other assets like derivatives or particularly bonds, these are what are known as over-the-counter markets because people come together individually, bilaterally. But there is platforms, and particularly on OTC markets like Bloomberg's fixed income technology, or the thing they call TSOX, allows bond traders to electronically see each other, what they're offering, bidding, or selling, and actually make markets. So next definition, an algorithm means to post digital assets to receive a return based on the algorithm's independent exchange of the posted assets and investment in other assets. Now, this is a bit of a mouthful, but can anyone guess what the DeFi version of this is?
Staking?
Say that again?
Staking?
You are correct. Yeah, there we go. So what would be the equivalent of staking? In
Interest?
yeah, you would generate interest, but you're really generating a return rather than pure spread-based financing. It's actually things like robo-funds or actively managed ETFs. This is where you're giving them your money and allowing them to exchange it into other assets and generate a return for you. So it's, you know, again, mechanically, it's a conceptually the same sort of process. Okay. An algorithm means to price and execute a trade between two different assets. Okay, go on.
Yeah, that's an exchange.
Yeah, it's like, but similar to the
Trading pairs?
It's they usually call automatic market makers.
Right,
So
right.
they're doing that in the DeFi. And in the TradFi world, you have what are called dark or liquidity pools. The dark pools tend to be inside institutions where they can cross trades between buyers and sellers, or liquidity pools are where they offer participation and they can provide another source of liquidity to the market. But effectively, you're coming in as a participant. Now, it's again, they may be more centralized in the traditional finance world, but I'm going to get back to this in terms of these automatic money market makers as decentralized as they appear. A unique individual digital asset or record that cannot be copied or broken into smaller versions of itself.
NFT?
An NFT, that's right. It's a non-fungible token. So in the TradFi world, that would be actually represented by a house or car title, remembering that although you may still have a paper certificate that states it, there's actually an electronic record somewhere that's backing it up. I think that's the end of my definitions. And what I want to cover here now is just to go into, so before I move on, what I was really trying to show is that there are very mechanical, from a process perspective, similarities between DeFi and TradFi. The difference is that in the TradFi, there's a well-established infrastructure that operates at a huge scale and deals with institutional capacity and volumes, but still tends to be slow and lumbering and very inflexible and very product specific. Whereas DeFi has got faster in the sense that it seems like it can settle and transact quicker, but lacks some scale and capacity as well as some functionality. But fundamentally, they are achieving the same things in slightly different ways. And it's the similarities and differences that really, are important, and we'll come to that at the end. But when we're looking at settlement and infrastructure, and this may be new to different people, but I'm going to look at what happens in today's markets versus what happens in the crypto DeFi world. So in today's world, you have two parties that are either going to have an OTC, over the counter, what I described, an execution, or they're going to go to an exchange and agree an executed trade. If you're looking at the crypto DeFi world, you can go to a crypto exchange and exchange your digital or crypto assets, or you can have a smart contract that says this is what we want to do, and that gets into the decentralized exchange, or other protocols. In our current world, you would take your trade that you've executed, send it to your clearing broker or custodian, and they would usually match it through a trade matching engine. You have what's called an affirm confirm to say that we both agree my buy matches your sell, and that's recorded in a depository, and then it's settled at some time in the future. Well, the tendency in the crypto DeFi world is, again, with your crypto custodian through a smart contract, is then to record your transaction on Ethereum or one of its competitors like Cardano, Solana, or others. And then there's usually some form of transfer agent, is someone's tracking who owns whichever digital asset there is on its register. In the regulated world, you have a very strong registration regulations around 33 Act, which deals with how securities can be issued, and then there's a regulated issuance of a security to a depository or a clearinghouse. In the same way, in the digital world, if someone's now minting a new token, they go through a smart contract and again mint or create the asset in one of the public blockchains, Ethereum, Cardano, Solana, or otherwise. But as you can look, they're actually looking pretty similar in terms of you're actually taking two parties to go through some sort of protocol to agree a transaction. And effectively, although Ethereum is a decentralized network, they're really recording their transactions to Ethereum to act as a central clearinghouse. So fundamentally, it's beginning to look the same. So what are the differences or benefits? Well, the crypto world offers intraday settlement, which only a couple of markets do today. You've also got a consistent infrastructure for all assets. You can literally create a smart contract to do anything you want on Ethereum. Whereas what I've recorded on the left is basically an infrastructure that exists for every different product in a regional market, and then obviously multiple versions in every different region. And then you've got the idea of crypto and digital assets, which obviously the traditional finance cannot handle right now. However, saying that, there are some detriments. On the crypto DeFi world, I mentioned there's performance issues in terms of scalability, capacity, and latency. Although they're offering settlement within the day, the time frame can be arbitrary, and it's not necessary. It can never be real time, which is often the requirement to do intraday financing and intraday settlement. Unfortunately, within blockchain world, there's no accounting. They're basically timestamp transfer logs, And so therefore it makes it difficult in terms of reconciliations. And this is part of the problem you see in terms of, how do you account for your tax liabilities? How do you actually account for your asset and liabilities within these different protocols, particularly in the DeFi world? There's no concept of payables or receivables. A blockchain records what's happening today, and it has the history of what happened in the past. But you have no means in which you do in a classic ledger to record a future dated payable receivable. And there's really no spread-based financing. When you talk about staking, like I said, you take your asset and they swap it into another, and although they may offer you an interest rate return, they're really entering into a swap transaction on the other side, hoping that the asset goes up more than the interest that they owe you. And with as limited to no legal recourse, and this is the real problem for DeFi to attract TradFi, is that these public blockchains that are offshore, that have no legal recourse, if something goes wrong, either with the DeFi protocol or, in some ways the exchanges are regulated or listed, particularly in the US, then there's some recourse there, and particularly with custodians. But, any digital custodian that's offshore, you've got limited recourse against security. And again, we've seen protocols that are vulnerable to hacking. And outside of confidential smart contracts, most of smart contracts work by being published on the public blockchain. So therefore, you're disclosing your terms, which allows them to be front run or spoofed. So that's just a quick thing to say. Both they're similar, but there's challenges in both. So I'm going to go through why is this comparison important. So as regulations are considered either for TradFi or DeFi, their overlapping similarities should be considered for uniformity and minimal differences. And what I mean by that is, if you can show that your DeFi product has mechanically the same processing and accounting as a current product, you effectively can say, hey, I'm doing nothing different than what's being done today. And again, wrestling with the idea of true decentralized processing and peer-to-peer or B2B settlements does make for some people to be wary. But again, I've mentioned that there's over-the-counter markets with bilateral settlements. So again, you've got an opportunity. I think we as an industry have an opportunity to really sort of educate the regulators that while we're doing it in a decentralized way, we're not necessarily doing it any differently than today. The consistency also allows solution providers to see how TradFi can leverage the technology of DeFi and how DeFi can support legacy TradFi use cases. And I think this is the competition that's going on. TradFi is trying to find a way to tokenize or digitize itself and leverage the efficiencies and benefits, particularly in terms of reduction of risk and errors which decentralized transactions could offer. And the DeFi world is jealously looking at all the assets that TradFi has, because it's 3 orders of magnitude bigger than what current DeFi is. But because of their limits of scale and because of their open nature and limited recourse, there's a challenge going on there. So I can tell you, I can advise anybody on either side of the fence what the answer is for them to do. And by all means, reach out to me if you want to know. But there's some open challenges there, both in terms of digitizing TradFi and allowing DeFi to operate with TradFi assets. So based on the Bitcoin network, the crypto, sorry about the typo there, DeFi maximalists regard no central authorities or intermediaries as absolute requirements. Whereas blockchain and distributed ledger technology has demonstrated there's no need for central authorities, but the need for intermediaries, e.g. wallet services, exchanges, custodian, transaction lifecycle applications are required and actually requested by the target consumers. Very few people are able to set up their own nodes in a crypto network and transact directly with them. It's that's a very specialized techie sort of geek thing. And both these things are true for DeFi and TradFi. So having an intermediary is got to be seen as the way to go forward, because people want to transact or invest, but they don't want to deal with all the logistics. The other side of it is the interesting part is that because of the limited scale and the limited assets that can be controlled in some of these protocols today, there's this push to layer 2 interoperability protocols. But they're really just identifying that the DeFi world is fragmented because they've got limited asset protocols. So they're asking for something to sit above them so they can communicate and transact between them. And if you think about it, the big banks and brokers really act as the layer 2 infrastructure for all those different market infrastructures that exist today. So really, the DeFi world is inadvertently replicating a copy of what TradFi did, which is that they're creating dedicated networks for certain assets and then creating a layer 2 that can talk to all of them and intercommunicate. So there's a risk that in that process, DeFi is actually just going to run down the roads of TradFi and recreate the same challenges that TradFi have today in terms of, flexibility and processing. This comparison, which I've gone through, shows that while blockchains have a more uniform applicability to any use case, customization for both TradFi and DeFi worlds hinder their adoption. And this is just, beyond the point being made here between TradFi and DeFi. As a principle, and this is me designing any process, is the idea you want to make it as generic and as flexible as possible. The reason for that is because then you can be adapted. But as soon as you introduce customization, you've got a more clunky application to support, and you're having to recreate or recode things, for any new use case. And one of the problems with DeFi is that they run off smart contracts, and each smart contract tends to be customized to the specific use case. So again, it's beginning to look like each of the applications for each of the products in TradFi have the same issue. Is there a way to make them generic? And this is one way to think about it. Ultimately, TradFi and DeFi have to be expressed in accounting terms for financial reporting, regulatory reporting or otherwise, and tax purposes. So without accounting, any solution is not a true ledger, but a mere continuous timestamp log. And accounting in TradFi is often done retroactively. People agree, record, settle, and then they finally reconcile or confirm all their transactions as occurred as they wanted to. Then they might feed it overnight to a general ledger, which then gets further reconciled and audited at month end or quarter end. So accounting tends to be treated as a retroactive process. And in the crypto DeFi world, it's only really being looked at, and digitizing legacy assets, even onto enterprise blockchains. Right now, there's only one that I know of that actually has double entry accounting within its distributed ledger. So, but again, accounting is the required way to express all the financial transactions in the world. It's a uniform language. The unfortunate thing is that we all do it at the end. So all our front-end processes are unique and independent, even though our back office, back-end reporting through accounting is actually consistent. What a concept it would be to bring accounting to the front door, not just the blockchain, but a blockchain with accounting, because then you would all be talking in the same language. Therefore, any network could talk to any other network because it would always be talking in accounting terms rather than dedicated product or use case transaction terms. And lastly, I'll just leave that both TradFi and DeFi have much to learn from each other. So if anybody's in one camp or the other and putting down their stake, no pun intended, then you're going to leave something out. So the idea that the TradFi world is just full of troglodytes and the DeFi world is crazy young kids, is not the way to look at the world. I think there's an opportunity for both to learn from each other, and I hope this has enlightened you in terms of what I believe are many of the mechanical similarities, but yet there are some significant differences. But maybe the way forward and how we can help both sides work together and then really realize the potential of what I believe distributed ledger technology has for the world. So I put my details in the chat, but here's where we open up for Q&A.
Hey, Paul, can you add your details to the chat again? Because I think there's a bunch of folks that started after we did the introductions, and they may not be able to see your details if they join later in the chat. But excellent presentation. Any questions, comments from the audience?
I have a question. So Paul, you had mentioned that one of the drawbacks to DeFi is still capacity and latency risk. With some blockchains like
Gerard, your connection is really bubbly.
Yeah.
I can't.
It sounds like you're underwater. Could you possibly write the question in the chat or do something about your audio?
Sure, sorry about that.
Oh, that's better.
Okay, let me try again. So, Paul, you had mentioned that some of the problems with DeFi is scalability, capacity, and latency, which we certainly see with blockchains like Ethereum. Do you think that blockchains like Solana, because of its the high transactions per second that it's capable of, solve some of those problems?
I question they're looking at their overall additive capacity, but there's some latency between what they have to do in stacking up their validators. There's a finite capacity there, so they create parallel processing via additive capacity, but it's not truly scalable capacity. So I haven't seen the exact. I don't know what the exact details of the results are. But the nature of their structure is that it has, by definition, a finite capacity, and if they're breaking it up, they're creating additive capacity. It's just a pure process engineering dynamics, and then they had the instance where even when I originally read their first white paper, the idea of stacking up the validators ahead of time. I said, well, what will happen if one of them goes down and they're waiting for that person to come back before the next one can go? And there was this process where they actually got half an hour behind real time because they were playing catch up. And so I'm not completely familiar with all the details of their transactions, but the way most people, particularly in Ethereum and others, are scaling is to break it into shards or clusters. And that makes additive capacity. And if you have to go between the shards or clusters, your process becomes much slower and and even possibly more expensive in terms of what you have to pay. So I know there's different ideas going on, but you really have to sort of drill into the details to understand what's happening. The other point I like to make is that these blockchains run on an idea that there's proposers of transactions, meaning people who actually transact, and then there's this virtual middle of processing, ordering, validation, and then sharing back. And that's dependent on, in some of these protocols, how do you know you're going to be in the next block? You don't know if there's a high capacity, so you have to wait and see, which makes your settlement arbitrary. And I would just carefully look at when they're saying like this volume of processing, how long is it between you actually suggesting a transaction and getting finality, and is there arbitrary latency in that process? Those are the details you've got to really look through in some of these public DeFi protocols.
Well, hey, I have a question. Thank you. Wonderful presentation. Learned quite a bit today. If DeFi is just going to mimic TradFi, and TradFi in different, I would say, different use cases would look different. I don't think every TradFi. I don't know whether every TradFi is very similar looking in different applications. So if DeFi is going to mimic TradFi in different, verticals with the customization, then don't you think the power of DeFi is now like diluted, and the benefits are no more there, and you are just the regulatory capture is now making you bend backwards to do all kinds of stuff.
Yeah, what I'm saying, and I tried to present, was actually the DeFi world in its limitations, in capacity, performance, and scale, are actually tending back to a TradFi world. So I'm not saying as a regulatory suggestion, recreate TradFi and DeFi. I'm actually a big proponent of creating DeFi and TradFi. But to do that, you have to sort of give up some sacred cows in the DeFi crypto world, and not to replicate TradFi, but just to understand what's actually required from a control and processing. So the real opportunity with decentralized settlement is that you've now got the idea of peer-to-peer settlement intraday, but most transactions are in the TradFi world are not about me passing something between us. It's actually, most of the time, we're just recording obligations. If you think about a loan, yes, it's a transfer of money between me and you, but then there's a series of payable receivables. So if you don't have this concept of future dated transactions or future dated obligations, you cannot meet the requirements of TradFi. But if you can do that in a decentralized world, you're creating intraday financing and real-time settlement, and that's really the opportunity. And the interest in that is, just to give you some statistics, in the U.S. equities market today, and this may get a little into the weeds, but there's on average about $300 billion in trades between everybody that's transacting New York Stock Exchange and the NSCC that clears it. The big guys, because they're trading and buying and selling with each other, they can net down their exposure, but there's still around about $30 billion in exposure because the trades are settling 2 days later. So the brokers have to post $8 billion in settlement risk collateral to cover that risk. So that's the idea, that if for any reason someone goes bankrupt, there's enough collateral there to cover the costs or losses for the counterparties. If we can move to that real-time settlement and intraday financing market, that $8 billion goes back to the balance sheet of the brokers, which either saves them money or gives them more balance sheet to use as their transactions. So the real opportunity is to reduce counterparty risk, cost, and exposure, but also, because we'll be operating intraday and real time, you actually create more liquidity in the market, and that's important because most of the major stocks can trade easily any day, and major government bonds can. But once you get outside that population, as long as the market's working, there's usually buyers and sellers. But when there's any problems, the markets freeze up. And the idea of being able to create, allow the TradFi world to get to real-time and intraday financing would be phenomenal. And the technology's there within the DeFi protocols and the ideas. It's just DeFi isn't preparing itself to be available in that regulated world, and the TradFi is struggling with the current protocols and their limitations.
Hey Paul, we've only got a few minutes left, but I know you've been looking at these challenges for quite a while. And again, we don't have time to get into huge detail, but you want to just maybe share how you basically looked at tackle these problems with Tapestry X?
Yeah, so when I look,
I know there's not a lot of time, but yeah,
no, I can cover it pretty quickly. When I looked at distributed ledgers, and this is back in 2015 when enterprise blockchain was taking off, and I was in the consultancy and was saying, okay, we've got to look at this and see how people want to use these. My internal analysis sort of said phenomenal potential, incredible idea, peer-to-peer settlement in hours, if not minutes, less, not eliminating all, but less reconciliations, and certainly error prevention. And exception processing is the bane of all operations in the financial services. There's tens of thousands of people employed just to chase after errors, even if the error rate is relatively low, just because of the hundreds of millions of transactions. But when I looked at blockchain, I said, okay, then they've got customized front ends, they lack scale, the capacity, they're not real time, they can't do future data payable receivables, so they don't have the idea of transacting periods, future date variables, the functionality to do proper financing transactions. And also they tended to be walled gardens and not interoperable with other networks or legacy infrastructure. So originally we were presenting those as, guys, you must be trying to fix these problems, but everyone was downloading what was available and playing with it and doing their proof of concepts. So Tapestry X was designed around to be configurable at the front end, to be high capacity, real time, and scalable with double entry accounting in the hashlink record, and then also to be interoperable with legacy infrastructure or network to network. And the key thing actually is the configuration, the simple way that we can configure any asset or transactions and also provide accounting. So we're actually talking in the language that any current ledgers work. But the real thing that people tend to remember is that we're able to synchronize the network on the transaction data alone. So we were able to push the controls to the edge and therefore remove the need for mining consensus algorithms or independent validators. And so that's the concept. But we built it to meet the performance and requirements of Tapestry X and of the capital markets world in the TradFi world. We found that because we're generic, and agnostic, we can more or less record anything. I think I saw someone flash up. If you want the links, I did put my links in the chat. So Wizard King Shop, interesting name. Your parents had an interesting surname and they had a creative idea for first names. So if my links are there, if anyone has them, it's a great. So anyway, that's.
Paul, thank you so much. And I just want to let everybody know, we do this this particular one on for banking, blockchain for banking, for what is it? Financial institutions, I think is what it is. Financial enterprise. So we do this on the third Wednesday of every month. We on the same link. If you're interested in this kind of content, please go to gbaglobal.org. We have a YouTube channel with over 200 videos. There, we do have our next event called The Future of Money Governance Law. If you have any interest in blockchain, cryptocurrency, digital assets, accounting, how the law handles any of this stuff, or what's going on in regulations, you won't want to miss it. If you can't be there in person, by all means, you can watch it online. I think it's free online, and our speakers will include Rick Edelman. Rick Edelman is the #1 financial advisor in the United States. He's on the Barron's, what do they call it? So it's like the who's who. I just forgot the title, but he's listed by Talkers Magazine as having being one of the 100 most important top show radio personalities in the country. He's written probably 15 books. His New York Times bestseller, the most recent one, was The Truth About Crypto. He basically trains financial advisors on digital assets, and he has a network of, he recently sold it, but he created a network of financial advisory companies all over the country. So the guy is literally probably the top guy in financial advisory, especially when it comes to blockchain and digital assets. And then Kyle Houtman will be there. Kyle is the vice chair of the National Credit Union Administration. So every credit union in the United States falls under his regulatory authority. He's spoken at our events before. He's very pro blockchain, and one of the 3 pillars of his goals are to basically help credit unions really use this technology and benefit from it. We'll have Dino Coltado Delacio, who is the Chief Information Officer at the United Nations Joint Staff Pension Fund. It's an $80 billion fund. He built the first blockchain solution for the UN. It's an identity management solution. So the caliber and quality of the speakers and attendees really are world class, and we would love for you to be there. So just go to gbaglobal.org. Paul will be there as a speaker. He'll be speaking on a number, so you get a chance to meet Paul in person. And so please do that, and please join us next month, same bat time, same bat channel. Any parting thoughts, questions, comments? Paul, do you have anything else?
No, I was going to say thank you for the participation, and thank you for the questions. And again, I've just put in the chat, if you got any other further questions or want to talk about any other topics or initiatives, then please reach out to me on LinkedIn.
Yeah, and listen, Tapestry X really is a phenomenal solution, right? I'm sure there are others. Tapestry X is the only banking and financial services layer 1 protocol that has gone through a blockchain maturity model assessment. It was evaluated by a team of experts, including Dino from the United Nations. So Tapestry X is a phenomenal product. Please check it out. I think you'll be extremely impressed. So thank you, Paul. I learned a lot today, as always.
Thank you, guys.
Bye, everybody.
All right.